So, how exactly is the branch profits tax determined? The first step in determining the branch profits tax is to determine the dividend equivalent amount. This amount is generally defined as the corporation's after-tax effectively connected income that is not reinvested in a U.S. business. If it's not reinvested in U.S. business, it's treated as though the funds were repatriated back to the foreign parent and therefore subjected to the branch profits tax. This dividend equivalent amount is then subjected to the 30% branch profits tax rate. To determine the net effectively connected income that has been repatriated to the parent, the following calculation is determined. The foreign corporation's net investment in the United States, or net equity, is analyzed at both the beginning of a tax year and at the end of the tax year. If the total investment or net equity went up, there's been no repatriation. If it went down, that is the deemed dividend amount or the repatriated investment. The U.S. assets for this purpose that are part of this net equity calculation are deemed to include all assets that could be considered effectively connected with the income generating business in the United States. The U.S. liabilities are all effectively connected liabilities. If the net equity in the United States increases between the beginning of the year and the end of the year, this increase in net equity is viewed as additional investment in U.S. assets and escapes the branch profits tax. The increase in equity is seen as an investment in the current year's effectively connected income and therefore escapes branch profits tax. If the net equity decreases between the beginning of the year and the end of the year, the net decrease is deemed to have been repatriated back to the foreign parent and is subjected to the branch profits tax. What's also important to realize here is simply shifting active business assets into passive investment type assets is enough to create a branch profits tax.